Thanks for tuning in to the weekly Signature FD investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start here with our chart of the week, and this one we're titling Celebrate the Wins. We spend a lot of time talking about near-term volatility and risks, and sometimes we forget to zoom out. This chart looks at the total return inclusive of reinvested dividends for the S&P 500 since 1925. It adds a trend line to show what the upward drift has been. In 100 years, the trend line has gained almost 11% per annum. Being an equity holder of large companies has created a lot of growth in portfolios. We should remember to celebrate the milestones that we hit along the way, and of course, remain cognizant of near term risks. So speaking of the near term, this chart is showing year-to-date returns for major asset classes. The S&P 500 is positive on the year at 2.3%, but there's been clear international stock leadership. Developed international stocks are up 18% and emerging markets 12%. The trend in international has had a tailwind from a weakening US dollar, which is down 9.5% this year. We continue to believe that global diversification makes sense here in 2025. In the economic data last week, we got two impactful categories. One was sentiment, and the other was inflation. Now, they go hand in hand. Inflation came in relatively benign, with consumer prices only up 0.1% last month. Owing to softer realized inflation and the rollback in some of the most punitive tariffs, consumer inflation expectations eased. We can see that in the blue line in this chart. With the improved inflation outlook, small business sentiment in purple and consumer sentiment in orange turned higher. Stronger sentiment could help boost economic growth in upcoming quarters. But the inflation improvement isn't without risks. Last week, retail gas futures rose about 6%. This chart is showing inflation adjusted gas prices in blue and consumer inflation expectations from the conference board in red. Now, that series differs from the one on the slide before that comes to us from the University of Michigan survey. But nonetheless, we can see that inflation expectations are strongly influenced by gas prices. So, this isn't a problem yet, but something to monitor as we go forward. Now, looking at the broader economy, according to data from the Atlanta Fed, the economy could experience a pretty strong bounce back in the second quarter from the negative first quarter GDP reading. Q1 was negatively influenced by trade policy, and some of that effect is set to reverse in Q2. While the true underlying growth rate was not likely negative in Q1, it's also not likely close to 4%, like what we're tracking here for Q2. Growth is probably in the 1.5 to 2% range today. Because economic growth is fine and there remains some inflation risks, the Fed is still likely in a wait and see pattern. According to market based probabilities from the CME Group, there's a 99.9% chance that the Fed leaves rates unchanged at this week's meeting. Chances for a rate cut don't meaningfully pick up until September. Now, what we'd want to see is a resumption of the rate cutting cycle, but on a measured basis. This chart shows the average pattern for stocks around the first rate cut in black. The green line is a subset of those labeled non cycles. In other words, that is when the Fed began cutting but stopped relatively quickly. That's similar to the pattern the market has traced out in this cycle, which we show in light blue. The dark blue line represents ongoing but slow and methodical rate cutting cycles. That is more in line with a policy adjustment because inflation is easing. What we don't want to see is a fast cutting cycle due to economic distress. Really, the reality for a stock investor is that the economic growth outlook matters more than the inflation outlook. This table shows the annual returns for the S&P 500 and for core bonds in different growth and inflation regimes. Today, we can classify economic growth as weak and inflation as neutral. But note that in all three combinations that include weak growth, stocks tend to underperform. So that's regardless of the inflation regime. Because economic growth is still positive despite being somewhat weak, we think earnings will be positive this year and probably into next year as well. That's important because valuations are relatively expensive. We therefore don't expect returns that are any higher than the rate of underlying earnings growth. For 2025, analysts expect earnings to grow about 10%, and in 2026, they expect about 16% growth. Now, estimates are typically too high, and they get revised down through time. Our best guess is that the next 2 years could see mid to high single digit earnings growth and probably mid to high single digit returns in large cap US stocks with downside risk if growth falters. To wrap things up today, the stock market's been a tremendous long term growth engine. Sometimes we should zoom out and celebrate the milestones we hit along the way as long term investors. International stocks have gotten an added tailwind from dollar weakness. They remain leadership in 2025. Small business and consumer sentiment have improved owing to benign realized inflation and the rollback of the most punitive tariffs. But there's a risk to inflation and inflation expectations if energy commodities catch an extended bid. Regardless, the growth regime matters more for stocks than the inflation regime. Economic growth appears to be settling at a fairly soft but still positive level. And it looks like there will be a decent bounce back in Q2. That said, valuations are rich, so investors should expect market prices to only appreciate as much or less than earnings grow in the upcoming year. As always, we want to thank everyone for joining us today and have a great week ahead.